You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Bear market? What bear market? Was there a bear market? You know, I think maybe we just dreamt it or dreamed it. Dreamt or dreamed? Is it dreamt or dreamed? I think it's dreamed. I think we just dreamed it. Yeah, maybe that was it. Because they're really, right now, we're right almost exactly where we were with the U.S. stock markets in January, late December, early January, just a few months ago. It's like nothing happened. At least at the close of business today, which is Friday, the 6th of June, 2020, which is when I record this. Right now, the S&P 500 is within, and we're just like closing in a minute. The S&P 500 is, let me just look at the latest number since we're really, really close. It is within, that's the Dow. I didn't want the Dow. The Dow is within 5% of where it was January 1st. And the S&P 500 is even better because it's a broader index. It's within about 1% of where it was on January 1st, 2020. So, bear market? What bear market? And what this should show you, there's an illustration here that's very valuable. Nobody, unless you had inside information in Congress, nobody in mid-February knew that the market was going to plunge over 30%. Come on, nobody knew that. What was it down? Almost 31% the S&P was down at its lowest point this year. And you didn't know it. Nobody knew it. Nobody predicted that, except for the bears who'd been predicting it. Like they're saying Grantham predicted it or something. Well, yeah, he's been saying it's going to go down for like 3 years. So if you get it eventually right, it doesn't really count. But you didn't know it was going to go down. You probably saw it declining. And if you were one of the folks who panicked, you may have panicked on the 10th, 11th, 12th, 13th, 14th of March. And COVID still looked bad and unemployment was climbing. So you thought all of those little rallies in the beginning of May, the end of March, beginning of May, were just trying to trick you. So you didn't get back in because you just didn't know where the bottom is because you're not that smart and you don't predict the future well. So let's say after a while you said, well, okay, it's looking pretty good. Maybe the beginning of May I got back in. Well, yeah, you did okay, but you only made about 11% back of the 20-some-odd percent you lost. You can't do this. It doesn't work. The market is untimable. But it usually recovers. Well, in the past it always has, and I expect eventually it always will. I didn't think it would happen this fast, but I don't predict the future, which saves me from a lot of grief. I don't have to say, ooh, I was wrong about that, like everybody else has to say. So the key, it's just too simple, but I need to repeat it over and over and over again. Invest for your risk profile. What is your risk profile? It's a combination of your need to take risk. If you need to know what you're going to need in the future, figure that out. And if you've got almost enough to get there, don't take too much risk. Go light on the risk. If you have a long way to go and you need to take more risk, then you need to determine what your risk tolerance is as part of that profile. How much risk can you stand? And the best time to test your risk tolerance is right after a decline like we had in March. That's the best time to test it. Would have been better to test it right there at the bottom in March, but we didn't know it was the bottom. So go take a risk quiz at talkingrealmoney.com. It's free. We don't even try to sell you anything. So check that out. Go take it and then build a portfolio based on that. Couple of things. One, this is one of my last chances to remind you we're doing a free online class on how to avoid bad brokers and find full-time fiduciaries on the 10th of June, So if you're listening to this after the 10th of June, hopefully we have another class up there. Just go to talkingrealmoney.com and sign up. It's free. It's on Zoom. 1. 2, I've been mentioning in the podcasts that, because I forgot to mention for a long time, that Financial Physics, my book, which you can buy at Amazon for $10, you can get via PDF for free at talkingrealmoney.com/free. You need to actually type in that /free to get there. Or you can get the really cool interactive version of it if you have an Apple device of any kind. You can get that at the Apple bookstore. It's called Financial Physics, 2 Fs, Financial and Physics with an F. So go check that out. We're also taking your questions. We do this all the time. We take them via mail, via contact form at talkingrealmoney.com. Hit the contact button, or you can call them in 24 hours a day, 7 days a week at 855-935-TALK. Also, you can call us tomorrow, starting at 3 p.m. Eastern, from 3 to 5 or noon to 2 Pacific, at that same number, and actually talk with us live, because Tom and I will be doing the show, Talking Real Money, live tomorrow. 855-935-TALK, 855-935-8255, or go to talkingrealmoney.com, hit the contact form, and we're going to get, let's get 3. Let's try and get 3 in today. We'll do 2 from the contact form, and we'll do 1 call. And let's start with this one. This is a question on Roths. First, I would like to thank you both for all you do. You're welcome. You have already answered a few of my questions, and I've learned a lot from both of you, along with Paul Merriman, our good friend. I have looked over the link below and would love to hear your thoughts on what this blogger who is with the FIRE movement has to say about Roth accounts. I just skimmed it on break at work and plan to look at it more in depth myself. And he gives me a link to a guy who has a blog, and the post is called Roth Sucks. Okay, one, you have to consider the source. This is a FIRE guy, which means financial independence, retire early. And his argument is Roths don't make as much sense for FIRE people. And I'll give him that, because a FIRE person is saying, I just want to get enough money to live a frugal lifestyle. Basically, like, I have a $100,000 a year job today, but I'm going to adjust my life so that in the future I can live on $40,000. That's a great goal. Good. However, what he's doing is saying Roths are bad across the board. I don't like black, white answers. I like gray. I love gray. My panels in my studio are gray. Gray is a great color because gray is in the middle. And Roths are gray. Regular IRAs are gray. His argument is, well, if you put money in a regular IRA or 401k, you get the tax deduction. And if you're going to be in a higher bracket now and a lower bracket then, it's better for you to take it. You're right. You're right. However, if you're going to be in a lower bracket later, you can't touch that money for a long time. Beware of that, without paying taxes and getting stuck with a penalty too. But if you're going to go long term and you're a good saver and investor, and I see this a lot with people who have retirement plans at work, they work 30 years at a job and they save regularly and they put money in their IRAs, they end up, in many cases, we call them the mass affluent, they end up with millions of dollars in their accounts and a relatively frugal lifestyle to boot. So they don't want to take all that money out at 72.5 and start paying taxes on it. And the Roth gives you the ability to not do that. No required minimum distributions. The other thing is we're betting on the tax brackets remaining the same in the future. But we don't know that. That's why I like to have a mix of pre-tax and post-tax dollars, so you have flexibility. I think you should have both. I don't think there's any requirement that you do one or the other. Unless you really believe you're going to be in a higher tax bracket in the future, then absolutely do the Roth, but we don't know. So I do both. Thanks for the question. I really appreciate it. 855-935-TALK, 855-935-8255. And let's take a call, shall we?
Hi, guys. Here's my question. I know with this coronavirus going on, they're allowing us to take out money of our 401k plan, I think without any penalty or taxes. What I'd like to know is I owe about $40,000 on my house. Should I take this out of the 401k plan and pay off the house? Or do I need it for the tax write-offs on your taxes, the interest payments? Thanks very much. I listen to your show every Saturday. Thanks.
Okay, first, the CARES Act, the Coronavirus Act, only allows you to take money out of your retirement plan up to $100,000 and avoid the penalty, not the taxes. So, unless you desperately need the money, you still should not take it out. You're going to pay taxes on it, and you want that to grow for retirement. 2, to pay off a mortgage? Heck no. If you have a mortgage and your rate is above 5%, don't pay it off. Refinance it for 15 years down to 2.9. It's just not worthwhile. When rates are so low, it's almost like getting free money, and it's free money with a tax deduction for your primary residence. So no, I would absolutely not at all touch the money in the 401k unless it was an absolute emergency. And I mean a life or death emergency, like you're going to get thrown out of your house or your kids are going to go hungry. Otherwise, no. To pay off a mortgage, not worthwhile. If your mortgage rate's high, refinance it. If your mortgage rate is low, stick with it. It's a good deal. And let's do one more sent-in question from TalkingRealMoney.com. And let me find it. I had it right here. Oh, there it is. It's about, the subject's investments. Hi, I have a 401k with Delta Airlines. I could use the S&P 500, U.S. Small Mid-Cap Index, and non-U.S. Stock Index and U.S. Intermediate Bond Index, or I can use their brokerage link to buy Fidelity funds or ETFs, such as the Total Stock Market and Total International, or I can buy VTWAX or iShares, etc., ETFs for no transaction fee. I only have maybe 10 to 12 years before retiring. Which would be the right choice from the above options? Well, you have at Delta a great plan. You really do. It's one of the better ones. And by the way, big shout out to Ed. You guys have a great CEO, by the way. Delta has a really good CEO. Although I'm sure the 401k predates that. I would go to 401411.com and take a look at our allocation. What you ought to do first is go take the risk quiz. So it's not about when you're going to retire. It's about your risk tolerance. So go to TalkingRealMoney.com, take the risk quiz, and then go to 401411.com and take a look at the portfolios we have there. I would probably suggest you go that way rather than try to build a portfolio with Fidelity or Schwab, only because the funds that they provide at Delta are higher quality than we see in a lot of places, and it allows you to get some of those asset classes we'd like to see you own outside of just the traditional total market funds. So I think just go to 401411, look up the 401411.com, look up the Delta plan, and then take the risk quiz. It'll tell you what your asset allocation should be, and then set it up that way. Thanks for the note. I appreciate it. You can always send a note to me at TalkingRealMoney.com, hit the contact form, or you can call 24/7, 855-935-TALK, 855-935-8255, and you can call that number live tomorrow when we do the show on KOMO Radio in Seattle, and we can actually have a conversation there between 3 and 5 Eastern, noon to 2 Pacific, 855-935-8255. Thank you for listening. Please tell your friends, your neighbors, your relatives, anyone you know that really some of the best financial advice you can get, at least it's honest and there's no game playing, is right here at the Talking Real Money podcast. So spread the word, because that's the only way we grow. There's no other way to grow a podcast. It's you, word of mouth. I'm not going to go out and buy a lot of advertising. That's just silly. Thanks for listening. Take good care of yourselves. I'm Don McDonald.
Talking Real Money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately, consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor.
Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.
Are we done now?